Welcome back to the Deep Dive. Today, we're really getting into something fascinating, the Fairfax Financial Holdings 2010 Shareholders Letter.
Yeah, this was a good one. It's not just your standard filing.
Not at all. It's like a snapshot, right? A
Yeah.
company hitting this big 25-year milestone, huge success, but then deploying this, well, incredibly cautious strategy,
Yeah.
especially considering the economic climate then.
Exactly. That's the core of it, the contrast. You've got this powerhouse celebrating phenomenal long-term compounding.
It's just incredible numbers.
Right. And then, in the same breath, they're putting up these huge defensive walls, really dampening their own short-term results quite deliberately.
And that's the paradox we want to unpack today. Our mission really is to understand that strategy. How did this proven long-term winner decide 2010 was the year to, well, pay almost $1 billion just to be cautious?
Why embrace that short-term pain? What were they seeing?
Let's find out. I mean, their legacy certainly gave them the runway to make that kind of choice.
Oh, absolutely. Think about it. 25 years, starting with just $10 million and growing that to $8 billion in shareholders' equity. The book value compounding, 24.7% a year. That's just top-tier stuff. Hit $379 per share by then.
And the stock price pretty much tracked that over the long haul, right? About 21% per year compounded over that same quarter century.
Generally, yes. Long term, it lines up. But then you hit 2010.
And the music kind of slows down, at least for a bit.
It really does. After all that growth, the book value in 2010, it only went up 5%, just nudged over that $379 mark.
Still up, but compared to almost 25% average.
Exactly. Net earnings were around $469 million. So yeah, 5% growth felt, well, muted. Definitely raised some eyebrows among short-term watchers.
But what's really interesting, and you flagged this, is how Fairfax themselves frame this short-term stuff. There's that table in the letter.
Ah, yes, the non-correlation table. It's almost funny.
It really is. It shows basically zero link between how the book value does in any one year and how the stock price does in that same year.
You look at the extremes, it's wild. Like 1996, book value rockets up 63%, and the stock goes completely bananas, up 196%.
Okay. Seems correlated there.
But then, just 3 years later, 1999, book value. Still great, up 38%. The stock price, it tanked, down 55%.
Wow. So the message to shareholders and to you listening is basically ignore the year-to-year noise.
Pretty much. Focus on the long game. That 24.7% book value growth over 25 years, that's the engine. And eventually, the stock price reflects that, even with all the bumps along the way.
Yeah.
That 21% return proves it out.
Right. Short-term swings are just distractions. Fundamental value wins out. And that mindset, that drives everything, including how they handled their core insurance operations that year.
Yeah, which brings us to the engine room, so to speak.
Okay, let's look under the hood then. Fairfax runs decentralized, right? Insurance subs manage their own underwriting.
But the investments are all handled centrally.
Yeah. So if the investment side was deliberately muted in 2010, you'd think they'd need the insurance side firing on all cylinders profit-wise. Did that happen?
No, not in terms of profit. And that was also strategic, believe it or not.
Really? How so?
Well, 2010 was a classic soft market for insurance. Premium rates were low, competition was fierce.
Okay.
So their overall combined ratio was 105.2%.
Ouch. Over 100 means an underwriting loss.
Precisely. A loss of about $236.6 million for the year from underwriting. And you saw it in the big subsidiaries, too, like Northbridge at 107.3% or Crum & Forster at 109.1%. They were feeling it.
Wait, so they spent more paying claims and running the business than they collected in premiums? Why would they accept that? Isn't the goal always an underwriting profit?
Long term, yes. But in a soft market, you got a tough choice. You can either chase volume, write a ton of business at those low, potentially risky rates, and hope for the best, which often leads to big losses down the line when claims come in higher than expected.
Okay.
Or you do what Fairfax did. You pull back, you write less business, even if it means your expense ratio looks worse because your fixed costs are spread over fewer premiums.
Ah, so they chose discipline over volume.
Exactly.
Yeah.
Management actually said they'd rather take the pain of elevated expense ratios during that soft cycle because the alternative, writing bad business, could permanently damage their book and their reputation. It's all about patience.
So they're essentially paying a price in the form of that underwriting loss to keep their standards high, hold on to their underwriting teams, and just wait for better market conditions.
You got it. And all that discipline serves to protect what they see as the real prize from the insurance side.
Which is the float.
Absolutely. That pool of premiums collected, but not yet paid out in claims. That's the money they invest. And despite the underwriting loss, the float actually grew nicely in 2010.
How much?
Average float was up 10.6%. It hit $10.4 billion. And here's the key. The cost of holding that float, basically the underwriting loss divided by the float, was only 2.3% that year.
So $10.4 billion in capital that cost them just 2.3% to use for investments. That's incredible cheap funding.
Extremely cheap. And their ultimate goal is always to get that cost down to zero or even make an underwriting profit, creating cost-free float.
And the letter gave some proof they weren't just, skimping on reserves to make that cost look low.
Oh, quite the opposite. Their conservatism runs deep. They actually show data on reserve redundancies for business they wrote from 2002 all the way to 2009.
Meaning they set aside more than they ended up needing.
Yeah. Northbridge, for instance, had an average redundancy of 7.6% over that period. McCrum & Forster, 8.9%. They consistently over-reserve. It builds in a margin of safety, protects the balance sheet, protects that float. Ultra-conservative.
Okay, so that discipline on the insurance side, it seems like it gave them the foundation, the confidence maybe, to be even more defensive on the investment side.
I think that's fair to say.
Because those investment numbers are where the intentional pain really shows up. Returns were just 3.9% in 2010. That's way down from the average of over 14% they'd seen in the 3 years prior.
Yeah, 3.9% is low. But it was, as you said, entirely self-inflicted and deliberate.
So what was the main cause?
The big one was the hedge. They put in almost 100% hedge on their equity portfolio. They ramped it up around May, June of 2010.
Wow, almost fully hedged. So basically neutralizing any potential gains from stocks.
Pretty much.
Yeah.
And the cost of maintaining that hedge throughout the year was massive. It cost them $936.6 million.
Nearly $1 billion.
Yeah, that alone knocked 4.2 percentage points off their total investment return for the year. That's why the overall return was so low.
Okay, that's a huge cost to bear. For a company built on compounding value, actively spending almost $1 billion to not participate in potential market gains. Why? Why such extreme caution? What was the fear?
That really is the multi-billion-dollar question, isn't it? And the letter is quite explicit. They weren't just worried about a recession. They were worried about something much bigger, much more prolonged.
Like what?
They were focused on what they call the unintended consequences of too much debt around the world. They saw parallels, potential parallels, to the U.S. in the 1930s.
The Great Depression.
Or Japan since 1990. Periods where nominal GDP basically goes flat for, 10, 20 years, and you get bouts of actual deflation, falling prices.
So not just slow growth, but potentially decades of stagnation, maybe even shrinking economies in nominal terms. That's a bleak outlook.
It was a very bleak scenario they were guarding against. And they saw specific signs that made them think it wasn't impossible, particularly in emerging markets.
Where were they seeing bubbles?
They called out China real estate specifically.
Yeah.
Very vivid example. They mentioned house prices in places like Beijing and Shanghai having quadrupled in just 4 or 5 years.
4 times in 5 years. That's concerning.
And they quoted this saying they heard there, buy 2 houses, sell one after it doubles, and you get the second one for free.
That perfectly captures the bubble mentality, doesn't it?
Absolutely. And they noted how much of China's GDP, maybe over 40%, was tied up in construction and infrastructure, fueling this huge demand for commodities, pushing those prices up in a way that looked, well...
parabolic.
Exactly their word, parabolic curves. And their reaction was blunt. We shy away from parabolic curves, so we continue to maintain our equity hedges. They just decided to step completely away from that risk.
Okay, so fear of global debt, fear of stagnation, fear of bubbles, that explains the equity hedge. But they went even further, didn't they? Hedging against actual deflation.
This is where it gets really unique, I think. They put on massive positions in CPI-linked derivatives.
Consumer price index, so inflation-linked bonds.
Not quite bonds. These were derivative contracts. Think of them as insurance. They had a notional value of over $34 billion, linked to CPI indices in the U.S., the EU, and the UK.
$34 billion notional, huge. And these paid out if prices fell.
Exactly, if deflation took hold. They specifically noted that cumulative deflation hit about 14% in Japan during its lost decades, and similarly in the U.S. back in the 30s. These contracts were designed to protect their capital if that kind of scenario repeated. It's like buying disaster insurance for your portfolio. Costs a small premium, but potentially saves you if the worst happens.
So the investment philosophy in 2010 was crystal clear. Survival first. Capital preservation absolutely trumped chasing returns, even at enormous explicit cost.
That's the message. Protect the capital base above all else when you perceive existential risks.
But even with all that defense, they weren't just hiding under a rock. The letter shows they were still active, using their capital for acquisitions.
Right. That's the other side of the coin. The strong balance sheet, protected by those hedges, allowed them to be opportunistic. They bought 5 companies in 2010.
Any standouts?
Well, there was first Mercury, a U.S.-based company in the surplus lines and specialty market.
Okay, for our listeners, what surplus lines mean again?
It's basically insurance for weird risks. Things that standard insurers don't want to cover, maybe too big, too unusual, too specialized. It requires real underwriting expertise.
Which fits Fairfax perfectly.
Exactly. And true to their contrarian nature, they even pointed out that First Mercury was based in Detroit, saying it appealed to their instinct to invest where others might be hesitant. Plus, it had a good track record, a 93% combined ratio over the previous 9 years.
Nice. And they were also expanding geographically.
Yeah, big push into potentially huge markets. They bought 41% of Gulf Insurance, which is a major player in the Middle East and North Africa.
Okay.
And they lined up a deal to buy Pacific Insurance Berhad in Malaysia, expected to close the next year, noting its strength in medical insurance, getting footholds in regions where insurance is still way underpenetrated compared to developed markets.
And there was that interesting bit about their runoff business, Riverstone, the GFIC acquisition.
Ah, yes, General Fidelity Insurance Company. That was a company already in runoff, meaning it wasn't writing new policies, just managing old claims.
And Fairfax bought it profitably.
Very profitably, right off the bat. They bought it for less than the value of the reserves it held. The accounting rules then meant they had to book an immediate gain, $83.1 million. It used to be called negative goodwill.
So they basically got paid to take over these liabilities because they were confident they can manage them down for less than the booked reserves.
Exactly. It showcases the value of that specialized runoff expertise they have in Riverstone. It's a niche, but profitable part of their operation.
And finally, on the people front, there was a key move to sort of solidify the structure for the future.
Right. They appointed Andy Barnard as president and COO of the Fairfax Insurance Group.
What was the significance there?
Well, Barnard had an amazing track record himself at Odyssey, one of their big reinsurance subs, compounded book value there at over 20% a year. Putting him in charge across all the insurance subsidiaries was about bringing more coordination, more strategic oversight, while still keeping that decentralized underwriting approach. It freed up the top leadership, like Prem Watsa, to focus even more on the overall investment strategy and capital allocation.
Okay, so let's try and synthesize this. If we look back at 2010 through this letter, what's the big picture?
It's this picture of deliberate, almost extreme caution on the investment side, paying that huge price for hedges because they feared global stagnation, debt crises, deflation.
Funded by the steady, if unprofitable in that specific year, cash flow from the insurance operations.
Where they chose underwriting discipline and patience in a soft market over chasing risky growth. This is a fascinating balance.
So the key takeaway for you, the listener, what does this deep dive tell us?
I think it's about strategic discipline and what that really means. Fairfax in 2010 shows that sometimes building long-term value requires making decisions that are actively painful in the short term.
Like spending nearly $1 billion on hedges.
Exactly. They didn't see that $936 million as a loss. They saw it as the price of resilience, the cost of ensuring they had the capital and the capacity to act decisively when markets eventually turned, or if their worst fears materialized. They were buying time and options.
Which brings us to that future potential.
Yeah.
Their stated goal, long-term, is 15% annual growth in book value.
Right. And when you think about the position they were in at the end of 2010, they had enormous untapped capacity.
How so?
Well, on the insurance side, they were writing premiums at only about half a time their surplus capital. In harder markets, they previously got up to 1.5 times. So huge room to grow premiums when rates improved without needing more capital.
And they were setting up shop in those emerging markets.
Places like India, where they noted insurance penetration was incredibly low, like 0.6% of GDP, compared to multiples of that in developed countries. Yeah. Massive runways for growth there.
So here's the final thought to leave you with. Given that unused underwriting firepower, that expansion into untapped markets, and that core philosophy of patience, just how much intrinsic value was Fairfax quietly building up, sort of coiled and waiting during those cautious years, waiting for the inevitable return of harder markets and better opportunities?
It really makes you think about the long game they're playing. It's a multi-year strategy that requires a level of patience most companies, and maybe most investors, just